All right, everybody, welcome back. It's time for another deep dive. And today's topic, uh, a lot of people find this one pretty intimidating.
Okay.
We're going to be tackling mortgages.
Yes.
We're going to try to really get into the nitty-gritty of how do you actually finance a home? How does it work? What are all the different things to think about? You find that perfect place,
Right.
the one that's got, I don't know, the bay windows you've always wanted or like the big backyard.
Yeah.
And then you get to that part where it's like, okay, but how do I actually get the money to pay for this?
Exactly. How do you make it happen?
It's so much more than just like swiping your credit card, right?
Right. Way more complicated.
So I've got an expert here with me today who's going to help us break it all down.
Absolutely. And I think you're right. A lot of people, when they think about buying a home, it can feel very daunting, and rightfully so. It's probably the single biggest purchase that most people will ever make in their lifetime. And so understanding this whole world of mortgages is absolutely crucial. And at its core, the place to always start is, what is a mortgage? And it's actually pretty simple. It's a special kind of loan that's just for buying real estate. And so the lender gives you the money to buy the property, and then you pay them back over time, usually with interest.
Okay, so it's a loan, but it's not like, other kinds of loans.
Mhm.
There's a lot more at stake.
There is. And the reason for that is because with mortgages, we have this thing called collateral.
Collateral.
Collateral. And collateral is essentially, I always just think of it as something valuable that basically backs up your loan. So in this case, with a mortgage, the house itself is the collateral.
Oh, wow.
And so this protects the lender because if for whatever reason you can't make your payments, the lender can actually take possession of the house, which is what we call foreclosure.
So it's like the house itself is vouching for you.
Exactly. Exactly.
Okay, that makes a lot more sense now because it's not just, money, it's a place you're going to be living.
Exactly. It's tied to this very real, very big asset. And so because of that, there are different types of mortgages, and each one has its own terms and conditions that are really important to understand. But the two most common ones that you'll come across are going to be fixed rate mortgages and adjustable rate mortgages. And we can start with fixed rate because they're the most popular.
Yeah, let's do fixed rate first. So fixed rate kind of sounds like what it is, right? Like something is fixed. So what is staying the same in a fixed rate mortgage?
That's a great question. So with fixed rate mortgages, the thing that remains constant throughout your entire loan term, which is usually somewhere between 15 and 30 years, is the interest rate.
Okay, so my interest rate never changes.
Exactly. Which also means that your monthly payments for the principal and interest stay nice and consistent.
And that's really good for budgeting and planning, right?
Yes. So much easier to know, okay, this is what I owe. This is what it's going to be for the next 15, 20, however many years.
It's not like my streaming service where it's like, oh, suddenly it's, $5 more.
Exactly. There are no surprises, which can be a huge relief, I think, when you're, thinking about home ownership. Now, that being said, there's the other type of mortgage we talked about, adjustable rate. Those are called ARMs.
Okay, ARMs, those are the ones I heard can be kind of like a roller coaster.
They can be. Yeah, you're not wrong about that.
Is that true?
They can be. And the reason is because ARMs start out with a lower interest rate compared to fixed rate. So that's very enticing.
Okay, so that's how they get you.
Yeah. And that lower rate is fixed for a certain period of time, but it's not the whole life of the loan. It might be 5 years, it might be 7, maybe 10. But after that introductory period, your rate adjusts based on whatever's happening in the market.
So it's like a teaser rate. It's like, come on in, we'll give you this great low rate,
Yeah.
But then who knows what happens.
And that's the risky part, because if market rates go up, your rate's going to go up, your payments could go up.
And could be a lot, right?
And it could be a lot. And that's the gamble with ARMs. They're definitely riskier than fixed.
Yeah, that makes sense.
Yeah.
So riskier than fixed. But it could work out, right? It could work out if you're really lucky.
Yeah. I mean, if rates go down,
Yeah.
if rates plummet, you're going to be sitting pretty.
Okay, but like you said, those are the two big categories. But there are also special loan programs, right?
Right. There are loan programs that are actually designed to make homeownership a little bit easier for certain people. And these are usually backed by a government agency.
Okay.
And those would be FHA loans,
Yeah.
VA loans,
Mhm.
and USDA loans.
So those are all government-backed, so they're a little bit less risky for lenders.
Exactly.
So let's go through those. So FHA, that's the one I hear about a lot, especially for first-time home buyers. What is it about FHA loans that makes them so good for someone who's never bought a house before?
So FHA loans are insured by the Federal Housing Administration.
Okay.
And because there's that insurance there, it kind of protects the lender, right?
Yeah.
If someone defaults on their loan, the FHA is kind of there as like a backup.
Right.
And since the lender knows, okay, I have a little less risk here,
Yeah.
they can be a little bit more flexible with who they give that loan to.
Right. So less risk for the lender usually means like better terms for the borrower.
Right. Yeah. It makes it easier to qualify. So for FHA loans, like one of the big things is that you can have a lower down payment.
Okay. That's a big one because down payments, like that's a lot of money.
It's a lot of money, especially, if you are earlier on in your career or you're, just starting to think about home ownership. And a lot of times, with conventional loans, you're having to put down like 20%.
20%? Oh my God.
But with FHA, it could be as low as 3.5%.
3.5%. That's huge. That's
It's
like
a big difference.
it's the difference between buying a house this year or like waiting another 5 years.
Exactly. It makes homeownership so much more accessible.
Okay, but there's got to be a catch.
Right.
It's got to be a downside to this.
So the trade-off with FHA is that you do have to pay for something called PMI, private mortgage insurance.
Okay. And that is
So because you're putting down less money up front with that down payment, the PMI basically protects the lender if you stop making your payments.
okay.
So it's an added cost for you, but it allows you to get into that house sooner.
It's like an insurance policy for the lender, but I'm the one that has to pay for it.
Exactly. It's usually like a percentage point or so added onto your monthly mortgage payment. So it does make it a little bit more expensive each month, but
Right.
you're in that house.
You're in the house. That's amazing.
Mm.
Okay, so FHA, we got that.
Yeah.
Now, what about VA loans? Those are the ones for veterans, right?
Right. For veterans, active military, anyone who's currently serving.
So how do those work?
VA loans are guaranteed by the Department of Veterans Affairs.
Okay.
And these are amazing loans. They're really powerful. So with VA loans, a lot of times you don't have to do any down payment at all.
Zero down.
Zero.
That's wild.
It's a huge perk. And usually you don't have to pay for PMI, private mortgage insurance.
Oh, wow. So no down payment and no PMI. Like, what else?
Well-
What else is there?
The other thing is that a lot of times VA loans have a really competitive interest rates, lower interest rates than you might find with other types of loans. And they don't always look at your credit score quite as strictly.
So it's like, thank you for your service. This is a little something to help you.
Exactly. It's to recognize the sacrifice that these folks have made.
Yeah, and make it easier for them to buy a home, which is just like, it's such a big deal.
Huge, huge deal. Okay. And then I got the third type of government-backed loan,
Okay.
which is USDA loans.
USDA, that's the Department of Agriculture. So why are they involved in mortgages?
It seems random, right?
It does.
But USDA loans are all about trying to encourage people to live in rural areas.
Okay.
So if you are looking to buy a house in like a more suburban or rural area, USDA loans could be a really good option.
Okay.
And just like FHA and VA, they also have really good terms. A lot of times you can put zero down. They also have lower mortgage insurance.
Okay.
So if you're looking to get away from the hustle and bustle, maybe have a little more space, USDA loans can be a great way to do it.
It's like they're trying to revitalize these areas and get people to move and live and work.
Exactly. Trying to give those communities a boost.
It's fantastic.
Yeah.
So we've got like a loan for every kind of person, basically.
Right. And the thing is, just like, there's no one-size-fits-all car. There's no one-size-fits-all mortgage either.
It makes sense.
It's all about your individual situation, your finances, what you're looking for.
Yeah, and not everybody wants to go the like government-backed loan route.
Right.
Right. Some people are like, I want to do this on my own. So if you're that person, then we're talking about conventional loans.
Exactly. That's your other big category.
Okay, so conventional loans. That's like the opposite of those government-backed ones.
Yeah, you can think of it that way. So conventional loans, they aren't backed by a government agency.
So does that mean they're riskier?
Well, they're definitely riskier for the lender because
Yeah.
they don't have like that insurance from the FHA or the VA.
Right, right.
So because of that, they usually have stricter rules about who can get a conventional loan.
Okay, so like what kinds of things are they looking at?
The big things are going to be credit score. You usually need a higher credit score for a conventional loan.
Okay, makes sense.
And you're also probably going to need a bigger down payment.
Yeah, we talked about that 20% sometimes.
Yep. 20% is pretty common with conventional. Sometimes you can find them for like 15 or even 10% down, but that's not always easy.
Right, right. So tougher to qualify.
It can be. But the good news is that since you're not dealing with like all the government rules and regulations, you might get a little bit more flexibility.
Oh, That's interesting. So more flexibility in what way?
Well, for example, some of those government-backed loans have rules about what kind of house you can buy.
Okay.
Like with an FHA loan, you can't buy a house that needs a lot of work. It has to be in pretty good condition.
Oh, I didn't know that.
Yeah. But with a conventional loan, you might be able to buy a fixer-upper. You might have more options in terms of the location or even the type of property.
Okay, so that makes sense.
Hmm.
More flexibility there. And you also get more flexibility maybe to negotiate, right? Like the interest rates, things like that.
Exactly. You and the lender can kind of work together a little bit more to come up with terms that work for both of you.
So it's like the trade-off is tougher to qualify, but then once you're in, you got more control.
That's a really good way to put it. It's kind of like, do you want to order off the menu or do you want to, like, cook at home?
Yeah, like that.
They both get you fed. They both have their pros and cons.
I love that analogy. Okay, that's so helpful because we've gone over a lot.
Yeah.
And it's like, whoa, mortgages, there's so much here. So what should people do? Like, where do you even start with all of this?
I think the biggest thing is just to understand the basics. Like, don't get overwhelmed by all the details. Just know what your options are.
Right.
And also to really think about your own situation. What are your finances like? What are you looking for in a home? What are your goals?
Right, because like you said, there's no one right answer for everybody.
Exactly. And that's why it's so helpful to work with a good lender, like a mortgage lender or a mortgage broker. They can kind of help you sort through it all.
They can be your guide.
Exactly. They're your guide in this crazy world of home buying.
Okay, so that's good advice. Get a guide. But what about like the big things to think about? So we've talked about the different loan types, but how do I know which one is right for me?
That is the million-dollar question, isn't it?
It is.
So I always tell people to think about it in these three buckets. Bucket number one is your financial situation. Bucket number two is your time horizon. And then bucket number three is your risk tolerance.
Okay, I think I get those.
Yeah.
So financial situation, that's like how much money do I have?
It's exactly that. It's your credit score. It's your debt-to-income ratio, which is basically how much debt you have compared to how much money you make. And it's also how much you have saved for a down payment.
Yep. Okay, that all makes sense. Now, time horizon, I think you said this earlier, that like how long do I plan on staying in this house?
That's it.
Yeah.
Because if you only plan on staying in the house for a few years, an ARM might actually make sense.
Okay.
Even though it's riskier, if you could get that lower rate for a few years and then, sell the house before the rate adjusts, you could be in a good spot.
Right. So think about the short term.
Exactly.
Yeah.
But if you're buying your forever home
Yeah.
and you're going to be there for a while, then having that predictable payment of a fixed rate is probably going to give you more peace of mind.
Right. So you really have to think about, am I going to be here for 2 years, 5 years?
Or do you need to know, no matter what happens in the world, my payment is this, and it will never change?
Okay. So that's just like, do I like to gamble, or am I like, I need to know exactly what things cost?
You got it. And that's different for everybody. Some people, they love the thrill of the unknown. Other people are like, no, give me stability and predictability, please.
Totally. Okay. This has been so helpful. Any other like last nuggets of advice as we kind of wrap things up?
The other thing that I always tell people is get pre-approved before you even start seriously looking at houses.
Pre-approved. So that means like going to the lender and saying, hey, will you even give me money?
Yeah. Basically, you're saying, here's my financial situation. Are you willing to work with me? And if so, how much can I borrow? And that can be so helpful for a couple of reasons. Number one, it'll give you a realistic idea of what you can actually afford.
Okay.
So you're not out there looking at like $1 million mansions when you can only really afford a condo.
Right. Don't get ahead of yourself.
Don't get ahead of yourself. And the other thing is that it makes you a stronger buyer.
Oh, how so?
Because if you're going to make an offer on a house and you can say to the seller, hey, I'm already pre-approved, I'm good to go, they're going to take you way more seriously.
Right. They're not going to be like, oh, does this person even have their finances together?
Exactly. They know you're serious.
Okay, that's a really good tip. Get pre-approved.
Get pre-approved. It'll save you a lot of headaches in the long run.
Awesome. Well, this was amazing. Thank you so much for coming on and talking about mortgages.
My pleasure.
This is definitely a topic that I think people hear and they're like, oh my gosh.
It's a lot.
It's a lot to take in,
Yeah.
but I think we broke it down really well.
I hope so.
And I hope for everybody listening, you feel a little bit more confident now about like what a mortgage is, what to think about if you're considering buying a home.
Absolutely. Knowledge is power.
There you go. All right. Well, that's it for this deep dive. We'll catch you next time.